first, I would say that, the market is comprised of, large cap stocks that are by definition are overweight within the indices, an Apple or a Google. And that is a very different thing than Main Street. So if Main Street traded on an exchange, they'd be down about 50% or so, bars, restaurants, and local businesses. The market, where it is now, I think it's justified. I think, the top 5 stocks in the S&P represent about a quarter of the market cap, but it also represents nearly a quarter of the free cash flow. So I don't think where we are when we look at indices is actually that crazy at all.
The biggest reason I've heard for why the markets deserve to be at record highs or why they've gone to record highs is the Fed, or just central banks, we'll call it writ large. Is the central bank policy that we have in place right now and that we anticipate to have in the coming months and perhaps even years enough to keep supporting a modest rally over time in the market?
I think it is, and that's right. I think the central bank, they were the earliest actor, throughout this, epidemic, and lowering rates and indicating very strongly that they're going to stay low is really incredible. So stocks trade relative to the risk-free rate, to bonds, what one could be guaranteed to receive from the U.S. government, and so the S&P trades at about 20 times next year's earnings, which on the face of it is not cheap, but in the face of a 10-year, that's less than 70 basis points. That spread, that earnings yield spread of 5% versus 70 basis points, it's a little bit over 4%. That's where we were last fall. So I actually think the market is, if you're going to be constructive on valuation now, it would be no different than someone who was constructive, last November, thinking that, well, the Fed's accommodative, there's growth, there's innovation. We're actually not in a very different place now than we were about 10 months ago.
Josh, you can be constructive on valuation and then you can be constructive on valuation. There are certain parts of the market that are relatively more expensive than others. We know that those large cap tech stocks are fairly overextended to the upside by many measures of momentum and perhaps by valuation. So where in the market do you go if you're looking to find value that can kind of turn into growth at some point?
Sure. That's a great question. So, I would point out, in our Cornerstone Large Growth Fund at Hennessy, we're exposed to all sorts of sectors. I would point out a few ideas that are, exposed to the economy kind of reopening. And last time I was on, we spoke about casino gaming and restaurants and things that are very obvious. There's a vaccine, people start going out and socializing and spending money at restaurants. Maybe a little bit more overlooked would be something like Henry Schein, dental supply distributor, providing products and practice management software to dental practices primarily in North America. 13 times cash flow, very strong returns on equity in the mid-20s, and certainly a tailwind coming from, elective procedures that are starting to pick back up with, dental practices opening, throughout the country. So a name like that, I think, is overlooked in an environment like this where we're talking about work from home and Zoom and Tesla, and this is perhaps the opposite of that.
So are there, speaking of the work from home kind of tilt that we've seen in the marketplace, are there companies out there that you like that perhaps still represent relative valuation, attractive relative valuation to the market, given the fact that we've seen huge run-ups in stocks like Zoom Video Communications or Tesla, other names like that during this run-up? Are there names specifically tied to work from home that you think are good?
Absolutely. I would point to Best Buy. So, looking at the chart, you wouldn't know that we were going through what we're going through. The stock has, raced to new highs, and it still is at about 10 times last year's cash flow. And I think roughly the same on a forward-looking basis. Incredibly strong company. I think Best Buy gets overlooked. They did well in the early 2000s and then kind of went through their swoon. But I think that they are a huge beneficiary of work from home, entertainment from home with streaming. And I would also point out that is what's probably underappreciated is their services business, which is less than 10% of revenue. But I think ultimately, something like a Geek Squad drives a lot of product sales, for things like routers and computers and things like that. So I think Best Buy has already capitalized on what we're going through here, and I don't see that ending, with a vaccine or anything like that. And I would also just throw out there, Sears used to be a go-to destination for appliances, and I think Best Buy will benefit over time. They already have, but they'll benefit greatly from that.